Sorry, let me.
All right. So again, thank you everybody for showing up. And so first off, just to introduce Oksana and I, my name is TJ Philly. My wife is Oksana Zingman. And I started in real estate with my first flip. It was a house hack back in 2002. And I converted a 1,200 square foot 2-2 that was purchased for $80,000 into a duplex that had a 900 square foot 2-1 and a 600 square foot 1-1. And I rented out the 1-1 and then sold the entire building for $220,000 in 2005. Oksana purchased a condo in 2005 that she lived in until 2011. And at that point, she converted it into her first rental, which she kept until 2017. We started a company together called Yellow Brick Road Partners in 2014. And the purpose of Yellow Brick Road Partners was to buy and flip or to buy and hold houses at foreclosure auction in King, Pierce, and Snohomish counties. We purchased our first house together 4 months to the day after we met. In 2019, we converted our strategy from flipping and single family rental to multifamily syndications. We started a company called Alicorn Equity. And at that point, we joined Brad Sumrock's Apartment Investor Mastery Group as personal mentoring students. And we took over 30 hours of courses on finding and underwriting and acquiring, syndicating and managing commercial multifamily complexes. We also joined Brad Sumrock's Millionaire Multifamily Mastermind in 2021. I just completed the MIT School of Architecture and Planning Commercial Real Estate Analysis and Investment Master's course. It was 60 hours of advanced commercial real estate analytics training. And currently we have an ownership position in 618 units, including Windsong Place in DeSoto, Texas, which is 200 units, and the apartments at Fountains Corner in Fort Worth, Texas, which is 418 units. And it involves 4 complexes. All right, so what I wanted to start off with was talking about investment types. And by the way, if you have any questions as I'm going through any of this, feel free to unmute yourself and ask a question, or if you can do the raise your hand thing. I'll try to keep track of that and make sure that your questions get answered as we go through this. All right, so the first thing is when you look at investment types, the very first thing that most people think about are your public traded securities. And these are things that anybody can buy. You've got your stocks, your bonds, your mutual funds, your spiders. Another common investment that a lot of people think about is crypto nowadays. And again, anybody can buy crypto. All you have to do is open an account, throw some money at it, and you can own some crypto. But then you get into a different class of assets where you're actually dealing with regulated regulations through the Securities and Exchange Commission, and they're not available on the stock market or on a market like Coinbase or anything like that. And instead, these are what are referred to as private placements. And there are 2 major forms underneath private placements that we need to be aware of when we're looking at investing in multifamily. And they both come out of the Jobs Act of 2013 Securities Rule 506C, which basically says that you can raise unlimited funds. There's a transactional exemption. It doesn't cover later sales by investors. General solicitation is allowed, which means you can advertise for investors. There's what's called a PPM, or a private placement memorandum issued. And all of the investors in a 506C private placement have to be accredited, and the issuer must verify accreditation. The other major type underneath the Securities Act is a safe harbor exemption, and that's called Rule 506B. In a 506B security, you can raise unlimited funds. You again have a transactional exemption, but the general solicitation is not allowed, which means we can't go out and advertise these types of investments to the general public. Again, a private placement memorandum is issued. And up to 35 investors may be what's called sophisticated, but they don't have to be accredited. And that's really important because the bar to becoming an accredited investor it is higher than most people can get into right away. Usually you have to have been investing for a number of years. You have to have, if you're a single person, income of 200,000 a year. If you're a couple, income of 300,000 a year for the last 2 years with no potential for you to drop below those income levels. And you have to have assets, not including your primary house, of at least $1 million. And those regulations are also subject to change. When you're going through a 506B, the accredited investors do not have to be verified that they're accredited. They can self-certify that they're accredited. So when we're looking at doing multifamily investments, what we want to do is really a lot of times target the 506B. And the reason is it does give us the opportunity to present investments to investors that are not accredited. And therefore, we may be able to raise more funds. We're still going to have to limit ourselves to only 35 sophisticated investors, but it gives us a lot more latitude. So then the question you may have is, well, what's a sophisticated investor? And a sophisticated investor is somebody who understands all the concepts around what the investment entails. How do you analyze the investments? How do you judge the risk? How do you, if we issue a PPM to you, do you know how to read it? Do you know what it's saying? Do you know what types of risks you're taking on in this investment? And so one of the large parts of running this meetup is to educate you so that you can be a sophisticated investor. All right, any questions so far? All right, then I will go on. All right, so I love this quote from Alice in Wonderland. If you don't know where you're going, any direction will do. And the reason I brought that quote up is today we're talking about setting your investment criteria. So I'm going to start off by giving you a little story. A couple of years back, I was at a legal seminar in San Francisco. And during the break, I did what I always do. I went up and started talking to other people at the conference. And there was a man that I started talking to, and he says, oh, what do you do? And I said, well, I invest in multifamily. And he just kind of, I tried that and I lost money. And I asked him, well, what happened? So there's a relatively famous multifamily investor who goes by the initials NB. And this guy learned about him and he listened to the guy's pitch and he invested 100,000 with NB. 2 years later, NB announced that the property was being hindered by the local government. And he decided he was going to sell it while he could. And so the property ended up taking a loss, which meant that my new friend also took a loss. We talked a little bit more about the structure of the deal. And really, when he was describing the deal to me, I came back to him immediately and I says, that really sounded like a risky deal. And I probably wouldn't have invested that up front. And I asked him, I said, so what was your investment criteria that allowed you to go after this investment? And his response was, what's investment criteria? Your investment criteria is basically the map that you're going to use to make sure that you are going to get what you want to get, that you're going to be able to do what you want to do, and go where you want to go with your investment. So when we start to look at investment criteria, what I'm going to do is I'm going to break it down for you as to the things that you need to think about in your investment criteria. So the first thing is, we're all here today because this is about commercial real estate, but there's a lot of different types of commercial real estate. First, obviously, we have multifamily, and your multifamily asset class includes everything from duplexes, like what you have, John, all the way up through apartment complexes with hundreds of units, like what Oksana and myself and Monica are all invested in. Another class of commercial real estate are your office buildings. And this can be a building like 1201 3rd Avenue in Seattle, or it could be a building like a strip mall down the street. Third class would be your industrial class. And your industrial class, this includes all of your warehouses, your manufacturing plants, your assembly plants, etc. A fourth class would be retail. There you're going to have your strip malls and shopping centers. You also have hotels. They can be full service, they can be economy, extended stay, hotels, motels, whatever. There's also mixed use, so combinations of other classes. And several years back, I was on the City Council of Issaquah, and I was on the Land Use Commission. And what we did was we created the 50-year plan for Issaquah. And part of that 50-year plan was that Issaquah wanted to incent developers to create urban villages. And basically what an urban village is it's a way to design your city so that you reduce the need for people to have cars. So the first floor of a building, or maybe the first 2 floors of a building, are going to be retail or commercial. So you're going to have offices or stores on those first floors. But then the floors above that, you're going to have housing. And it can be condos, it can be apartments, but it's mixed use. It's not falling into just one category. The 7th type of commercial real estate that you may come across is buying land. And you can have agricultural land or brownfield land or infill land. And you can actually generate money off of land. Let's say that you bought a piece of land that was down on the corner of 85th and Aurora. Well, you could turn it into a parking lot. And you're going to make money off of that land, even though you're really not building anything off of it. And then 8th, you have special purpose. And special purpose is considered anything that doesn't fit any of these other categories. So you got stadiums or theaters or zoos or, like I said, they don't fit the other categories. Any questions on the different types of commercial real estate? All right. So next up, you have to look at this and say, all right, what class of building are you interested in? And not all neighborhoods or properties are the same. And so when you look at a building, you look at it and you say, okay, well, what's the age of the building or the age of the buildings in the neighborhood? What's the average income of the people that are in the neighborhood or in the building? What type of jobs do the residents work at? How bad is the crime in this neighborhood? How much does it cost to live there? And what you find is that there's some standardized classifications, and they call them class A, B, C, and D. Roughly speaking, your class A is going to have been built in the last 20 years, and people live in those complexes because they want to be there. They could afford to buy a house if they wanted to, and generally speaking, they probably have 6-figure incomes or close to 6-figure incomes. Your class B buildings have 20 to 40-year-old buildings usually, $60,000 to $100,000 incomes, and pretty much considered upper middle class. Your class C, 40 to 60-year-old buildings, $35,000 to $60,000 incomes. It's lower middle class or new to workforce. And then you have your class D, and these are generally your 60-plus-year-old buildings, less than $35,000 a year income. A lot of times low-income housing. So you've got both the buildings and the neighborhoods are classified using that same taxonomy. And you also have the ability to have refinements on the classes by adding a plus or a minus. So you can have a B plus building in a B neighborhood or a B minus building in a B neighborhood. A rule of thumb to take into consideration, though, when you're selecting where you're going to invest is never invest in a property that's in a higher class than the neighborhood that it's in, because the property is always going to revert to the mean of the neighborhood. In other words, if you bought a Class A building that's in a Class C neighborhood, that Class A building is going to revert back to becoming a Class C building because the neighborhood is a Class C. You can't change the neighborhood. But if you bought a Class C building in a Class A neighborhood, now you have a lot of upside in the building, and you can do a lot of things to the building to increase the value of it and increase the value to you and your investors as well. This is especially true if part of your investment plan is to build value through FVA, which stands for forced value add. This means that you're going to convert the units into a higher classification. So you think about it, all right, let's take a Class C building, 40 years old, so built back in the uh, um, 60s or 70s, maybe early 80s, and maybe it still has the original 1.7 gallon per flush toilets, and it has the vinyl or Formica countertops, and it's not really that great looking on the inside. Well, what you can do is you can take money and you can use it to upgrade the units and turn them into much more modern looking units. And by doing that, now you can raise the class of those units from the current Class C, maybe up to a B minus or even a B. And do that without having to tear down the building and rebuild the building. All right, so I have an example down here at the bottom. What's wrong with this picture? You've got a great C+ property in a C+ neighborhood, and you're going to renovate the units with granite countertops and stainless steel appliances and hardwood floors. When we complete the renovation, the units are going to command a $400 per month rent increase. And the problem with this picture is the neighborhood itself does not justify this type of an upgrade. What you're describing is basically a conversion to a B+ property here. And if you do that, people making just shy of $100,000 a year are going to want to rent a unit like that, but it's in a neighborhood where the people are making $60,000 a year. And so are you actually going to be able to get that $400 per month increase? If you make this investment, you may never be able to get the rents that you expect or recover what you spent on the upgrades. So that's why understanding what neighborhoods, classes, and building classes are, it helps you make your investment decisions. All right, criteria number 4, what geographies are you willing to invest in? So what Oksana and I do is we want to find primary markets, which think of it as major cities, and these are referred to as primary MSAs or metropolitan statistical areas. And in those MSAs, we want MSAs that have higher than national average population growth. Well, why do we want higher than national average population growth? It's because if more people are moving in, then there's going to be a constant demand on the property, and you're going to have a greater ability to raise rents. We also want higher than national average job growth. And again, if they have higher than national average job growth, you're getting a lot of employment going on in the MSA, and people are going to be better able to afford to rent in your complex. Next, we want higher than national average income growth. And with income growth, we've got population growth, job growth, income growth. So we're basically setting ourselves up where there's going to be a continuous demand on our property so that we'll be able to maintain high occupancy levels. We also want someplace that has landlord-friendly laws. And that's really important because those landlord-friendly laws mean that, like here in Washington, we have issues where, the state has rules around whether or not you can do a criminal background check or whether you can use a credit report to deny somebody living in your apartment. And those types of laws are laws that prevent you from being able to evict somebody. Those generate a risk for you. So if you have this scenario where, all right, now you can't evict the person, but they're not paying rent, you still have to pay your mortgage, you still have to pay all the bills, you can't let the place go to heck. And so what you need to do is now money is actually coming out of your pocket and you're subsidizing your renter. It's much better to avoid that altogether and find places where the laws actually allow you to manage this as a business and not force you to lose money. So right now, if I looked at all these criteria, this would tell me that I would want to look at Las Vegas, Phoenix, Dallas, Houston, Tampa, Orlando, Jacksonville, Charlotte, maybe Denver. And just before I go on from that, there are other markets that we could potentially look at, but like I said, you look at someplace in Washington or Oregon or California or maybe New York or Hawaii, and those areas all fall under the guise of not being landlord friendly. And so we wouldn't want to invest in those areas. And if I go back up to the story of the friend that I met at that conference a couple of years ago, he didn't have any investment criteria. And he was basically saying, oh, well, this guy is really famous and he makes a lot of money doing this. He has to know what he's doing, but he didn't understand his investment criteria. And that guy was willing to do an investment in one of the suburbs of LA that had very landlord unfriendly laws. And basically, it was because of those landlord unfriendly laws that he ended up losing money on that complex. All right, so here's how I would look at structuring the investment criteria. We start off with the apartment building class. So we've got a class A, class B, class C. I don't really want to invest in class D. It's older neighborhoods, it's low median income. There's a higher probability of tenants not being able to pay their rent. So personally, I'm not going to look at a class D property. Now, what neighborhood am I going to look in? I'm going to look in class A, B, and C neighborhoods. Again, I don't want to invest in a class D neighborhood. I'm going to look for a stabilized property, and that means that it has greater than 80% occupancy. And that's important for a couple of reasons. One, because it's going to impact my ability to get financing and the type of financing I'm going to be able to get. But it also means that I'm not going to have a huge economic vacancy. So it's going to be a lot easier for me to generate the types of returns that my investors want if I have a stabilized property. Now, there are cases where you may want to buy a property that isn't stabilized yet. So if you think about it, if you were investing in building a brand new Class A complex in a Class A neighborhood, and you're involved in, getting involved pre-construction, all right, it hasn't been leased up yet. And so in that case, you may be willing to put that criteria aside and say, all right, in that particular scenario, I'm willing to void that investment criteria. Next, personally, I look for properties that have value add potential. So that means the ability to increase value by either lowering expenses or increasing income. And the goal is not to create a slum. I'm not trying to cut costs just for the sake of cutting costs. What I want to do is I want to increase value to the renters while I'm making it less expensive for me to manage the property. And you can do that in a lot of really creative ways, and we'll get into those in some future meetups. The location criteria that I'm about to come through and show you will also help you generate higher returns and lower your risk. And that is legal. We want to look for areas that are landlord and business friendly, where if there's rent control or if it's hard to evict for cause, I'm not going to go for those. Cap rates, I look for properties that are have higher than average cap rates. And the cap rate is how you value the property. And a high cap rate means that you're getting the property at a better value. Again, we'll go through the math of how all this works in a future meetup, but a property at a 5 cap is going to be much less expensive than a property at a 4 cap. We want the strong job growth so that our tenants don't become unemployed. And we want income growth so that they can afford rent increases and keep up with inflation. We want population growth so that there's a constant demand pressure that keeps the average rents from declining. And we want an affordability gap. And the affordability gap means that our tenants cannot afford to buy a house and therefore move out on us. So that means that I'm primarily going to be looking at my Class B and C apartments. Class A, I'm willing to go for, but you're probably not going to find affordability gap in your Class A's. And then size. I want to target units that complexes that have greater than 60 units. And the reason is when you get to 60 units, you can really afford professional property management. And that means I don't have to worry about going out there and managing the property myself. I can hire a property management company. They'll have people working on site every day. We'll have maintenance people. We'll have lease agents, et cetera. And it's a fully functional business that I just happen to be the owner of. All right, any questions so far on the investment criteria structure? All right. So if I took all this and wrapped it all together, I'd say our target asset class is A, B, or C class commercial multifamily real estate in A, B, or C class neighborhoods that has a value added potential. The location criteria will feature above average cap rates, a landlord and business friendly legal environment, good job, income, and population growth, and an affordability gap that ensures stable occupancy. And that ends up becoming my investment criteria. And I can talk to anybody about that, tell them my investment criteria in just a few seconds. So if I was talking to Monica and Monica had a potential investment, I'd say, well, this is my investment criteria. And she'd say, all right, TJ, here's how this investment meets your criteria. Would you like to invest? All right, any questions on that? All right, in 19 and 20, our primary targets included Dallas, Houston, Phoenix, Vegas, Denver, Charlotte, North and Central Florida. We've subsequently added Charlotte to that. Oh, no, actually, Charlotte was already in that list. You know, other parts of Texas are also probably included in that at this point. Our secondary target markets include cities in the rural mountain time zone, South Central time zone in the US, the Old South, including rural Texas and the Florida Panhandle and Georgia. But conformance to location criteria is going to be performed on a case-by-case basis. In other words, I'm not going to take absolutely every place in the South. There may be markets that I'm really not interested in down there, or the same thing in the Midwest. So, you know, I may invest in Oklahoma, but I probably wouldn't invest in Illinois. We want apartments that are good, solid working class housing where there's a low turnover of tenants. We're going to accomplish this by buying in areas where B and C class tenants cannot afford to buy houses, but they have little fear of losing their job or their income. And our goal is to provide a nice, clean, safe place to live where the tenants can be proud of their community and not feel the need to move elsewhere. We want our investments to provide tenants with a home that they're proud of where they live. States like Washington, Oregon, California, and the Northeast US may meet some of the criteria, but they fail when it comes to the landlord-friendly laws. Rental caps or laws that make evictions for cause difficult means that we would have higher costs and therefore lower profits for our investors. Alicorn Equity does not choose to invest in those markets. However, if you're interested in those markets, I can put you in touch with other investment firms that do have offerings in those markets. All right, so that's what I wanted to show you guys tonight. If everybody wants to unmute their microphone, let's talk and get any questions answered that anybody has. Hey, Monica.
Hey, TJ, John here.
Yeah.
Question for you. So you talk about forced value add. You know, with the current like labor shortage, are you finding difficulties, you know, having people renovating your properties?
Well,
I mean,
keep this in mind when we're talking about forced value add, and that is that we're also hiring professional property management companies, and we're going to have a maintenance person on site at the property. And so a lot of the forced value add can be done by the maintenance person, or you know, because we're dealing with professional property management companies, you know, they have access to their own contractors for being able to do things. So, you know, let's say that we're going to go into a complex and we're going to renovate the kitchen. So we're going to tear out the cabinets and we're going to put in some new cabinets. We're going to work with our property management company for doing that. And we're going to talk to them about what our business plan is before we even buy the building. And they're going to know that, on any given month, we have 5 units that we're going to upgrade. And so they're going to plan out their labor so that they can turn 5 units per month for us and convert them into the new higher rent eligible units. And then it just becomes a matter of making sure that you can order your supplies and have your supplies there on time. That may involve buying some things and putting them in a storage unit on the complex or storing them someplace until you're ready for them. But it's not as complex as what you find in, like if you have a duplex, you're not having a maintenance guy at the ready to go out there and do everything. So if you're going to go out there and try to hire somebody, it's going to be a lot harder for you to hire somebody than it would be for us to upgrade 200 units in a complex.
Right. Beautiful. So you got scaled on your side.
That's exactly why we're trying to do this with the multifamily. Like I said, Oksana and I, we started with single family flips and single family rentals. And it was a great business for a number of years, but it's just gotten harder and harder and harder to make money in that environment, especially up here in the Seattle area. We used to buy properties at auction up here. And when we first started, you could buy a property at about 65 cents on the dollar at auction. And, a couple months back, I was looking at properties coming up to auction. They were going to auction at like 90, 95 cents on the dollar. And you can't make money if you're buying it at that price. This was really a strategy that we decided to go into because it was getting harder to make money through the flips and the burrs and all those things.
Right. And TJ, so what is your exit strategy? I mean, criteria, keep it for 5 years, hit a certain number. What's that number?
Well, all right. So, and like I said, we'll have future sessions where we'll go through this in a lot more detail. But basically, when we get into a property, before we even get into the property, what we're going to do is we're going to do some pretty heavy duty analysis on that. We're going to look at how it performed for the previous owners, and then we're going to project out into the future what we think the cash flows are going to be well into the future. And that's how we're going to, that information is what we will come back and present to potential investors. And we're going to say, all right, so we found this property, we got this property locked up, we're going to be closing on it in 60 days. And we're projecting that this property is going to generate a cash flow to our investors of 6%. And it's going to generate a IRR of, let's say, 15%. So what that means to you, if you were looking at investing in something like this, and I'm just going to use some round numbers because it's easy to do the math in your head, but let's say that we have you're going to invest $100,000 and we're going to get a 6% cash flow and a 15% IRR. That means that every year that you're in this investment, you're going to be getting $6,000. Now we're probably going to split that up and, we may pay you quarterly, we may even pay you monthly. It depends on how things work out when we get into the property. But let's say we were going to pay you quarterly. All right, so we're going to take that $6,000, divide it by 4. So that means every 3 months you're going to get a check for $1,500. And it'll go up sometimes, it'll go down sometimes, depending on what was occupancy like, did we have any expenses that we weren't expecting, etc. But this is what our target is. Now let's say that we hold on to that property for 5 years. All right, 5 years, 6% return, you've gotten 30% back on the deal so far. Are you tracking with me?
Oh yeah.
All right, so now if we're going to get to a 15% IRR, 15 times 5 is 75. Let's back out that 30 that we already acknowledged that you're going to get. What that means is we're also projecting that if we turned around and sold this property in 5 years, that you're going to get 45% back at that point. So when we sell the property, now you get your original 100,000 back, you get another 45,000 back, and up to that point, you got paid a total of $30,000. So you end up making 175,000 off of your $100,000 investment. And the beautiful thing about this, since you're doing duplexes right now, is you never had to do anything other than write a check. That's your only responsibility as an investor in something like this, is you put your money in and you actually own a percentage of the building. We would set up a LLC and you become one of the owners of the company because you're one of the members of the LLC. And that gives you the rights to the profits from the investment.
Awesome. That makes total sense. Further questions like, do I get all the tax benefits of a landlord, for example, 1031 exchange? Can I roll that into, when we exit, can I roll that into something else, the next investment?
So when you do a 1031 exchange, that's something where it would need to be set up properly to do something like that. And that's something where I was thinking next month when we do this, that we would be talking about syndications and how syndications work, and we get into this a lot more. But basically, in a syndication, there's going to be a general partner, and the general partner is who's actually running the investment. So let's say that I got this fictitious building, 200-unit apartment complex, and John, you've invested in it, Monica invested in it, and Joseph invested in it. And so now we've got this complex. You are LPs in the LLC, you're limited partners, and I'm the general partner in the LLC. So technically that means that you are prohibited from actively managing the property. That doesn't mean that I can't, ask you questions about what you would like to see us do with the property. It just means that you can't force me to do whatever it is that you want to do with the property. So if you came back to me in 18 months and you said, TJ, I need you to sell this property, you can't force me to sell the property, because that would not only impact you, it's going to impact all of the other investors at the same time. So the GPs are the ones that actually have the right to make the decisions. The only thing that the LPs really need to do is put the investment in, and then basically hold me accountable, or hold your GPs accountable in that scenario. So if we go back to that example that I gave earlier, the guy didn't have any investment criteria. He also didn't participate in any of the calls that his GP was having about the property. And so, it was just like, oh yeah, I put the money in, I see some money coming back into my account, life is good. And then all of a sudden it's like, oh, the property sold and I didn't get everything back that I was expecting to get back. And now he's upset. Well, those communications are going on between the GPs and the LPs on a very regular basis. And, if you don't show up for the meetings, or you don't read the emails that come to you, there's only so much I can do as a GP to force you to pay attention to your investment.
Got it. I'm a little bit ahead of myself. I guess I'll be attending the next.
Hey, love to have you back next month.
Yeah, and TJ, just and how many projects have you done, if I may ask?
So yeah, I was showing at the beginning that we're currently invested in about 618 units down in Texas, and we're constantly looking at other ones. In fact, there was one a couple months back that Monica and I almost did together, but that one ended up not working out. So we're constantly looking for new investments, and our goal for this year is to have 3 more by the end of this year.
Okay, great.
Any other questions?
I think I'm good for now.
Okay. Monica, Joseph, Oksana, do you guys have any questions?
No questions here.
All right. So as I was just telling John, the plan for next month was I was going to go through and do a deep dive on what is a syndication and how does it work. it kind of sounds like what you were saying, John, that you'd be interested in that. Does that sound like a good plan for everybody else?
Definitely for me. Yeah.
Cool.
Yes, sounds great.
All right. All right. Well, if nobody has any other questions, I'll go ahead and give you guys back the balance of your time. It was great to meet you, John. And oh, by the way, John, I'm going to put a link into the chat window.
Okay.
And you know, one of the things when we're talking about these types of investments, you know, for if you ever did want to spend some time one-on-one talking to me, let me just go ahead and put this into chat.
Okay.
Give me a second. You can just give me your contact information, and there's also a Calendly link where you can set up some time on the calendar with me, and we can talk about things in detail and go any direction you want.
Awesome. Awesome. Appreciate it. Appreciate your time.
All right. Thank you, sir.
All
And
right.
thank you, everybody, for coming.
And TJ, the next meeting, you're going to be sending out links and invites, right?
Yeah, I'll be sending out links and invites to the next meeting. I know this one, we didn't have a huge amount of advance notice, so it was a little bit smaller. But yeah, if you have any friends that you think might be interested in this, feel free to invite them. I'd love to have more people. This was a meetup group that existed for several years, and then it kind of went dark for a few years, and now we're relaunching it. So we want to get more people involved, and just love to have you invite some friends.
Okay, will do. Thank you.
All right, thank you.
Bye-bye.
Bye-bye.
Thanks, TJ. Have a good night.
All right, you too.
Bye, guys.